Hello and welcome to this webinar on IFRS 16. I'm Catherine Donkersley and I'm joined today by IASB board member Stephen Cooper. This is the sixth in a series of webinars following the publication of the new Leases standard. Today we'll be talking about the disclosure requirements for lessees in IFRS 16. Just to note before we start that, as always, the views presented in this webinar are those of myself and Steve and don't necessarily represent the views of the board or of the IFRS Foundation. Today we'll be talking about lessee disclosure. We'll summarise the requirements in the standard and why each of the requirements is there. Every disclosure requirement in IFRS 16 exists because it relates to a particular information need that users of financial statements have highlighted as being important. Understanding what those user needs are will help companies in deciding how best to apply the various disclosure requirements. For that reason, I'm very pleased to be joined today by Steve, who can provide insight into the feedback the board heard about lessee disclosure and what the board had in mind when they developed the disclosure requirements in the standard. So, Steve, before we get into the detail, perhaps you could give a bit of context about the board's overall approach. The disclosure requirements in IFRS 16 are really quite different to today's lease disclosures. Why did the board decide to make changes?
Okay, thank you, Catherine. So users of financial statements have shared many opinions about today's lease disclosures. And really there are two main concerns today. The first is that many lease notes tend to be lengthy, with lots of detail, and they don't necessarily provide a lot of information. We often hear this described as boilerplate disclosures. The second problem is that despite containing a lot of words, today's disclosures are often not actually communicating the information that investors think is most useful. What users want is concise, relevant disclosures about the most important information. So the disclosure requirements in IFRS 16 were developed with the intention of enabling companies to provide exactly that. In other words, to enable them to identify what the genuinely useful information is and disclose only that.
Thank you. And you're actually preempting there something that we'll be talking about later in the webinar, the fact that companies will need to use some judgment when applying the IFRS 16 disclosure requirements. So given that that's the case, could you talk about comparability between companies and whether that was a priority for the board in developing the requirements?
Yes, of course. Comparability was a big priority. As I think was addressed in the first webcast in this series, being able to fairly compare companies is one of the things investors wanted to see achieved by the new Leases standard. It's a fine balance though, because the obvious way to achieve comparable disclosures is just to give a list of the required disclosures that all companies need to comply with. However, it is exactly those long lists of requirements that companies tell us is the reason why they end up giving those boilerplate disclosures. That's because a long list of mandatory requirements limits a company's ability to focus only on that information which is most useful in their particular case. So our challenge was to develop requirements that would lead to both comparable disclosures across companies, where this is needed, but also provide companies with enough room for judgment to focus on what is really important information for their particular lease portfolio.
That context is a good introduction to the high-level summary of the IFRS 16 disclosure requirements that you can see on this slide. There's essentially two parts to those requirements. First, a set of mandatory quantitative disclosure that, if material, needs to be provided by all lessees. These are the pieces of information that investors identified as being important for all material lease portfolios. These disclosures need to be provided by all lessees and will be directly comparable across different companies. Second, the standard requires further disclosures to be made if there is any additional information that users of financial statements would need in order to assess the effects that leases are having on the lessee's financial statements, and this is where judgement comes in. We'll talk in detail about each of these two elements. Starting then with the mandatory quantitative disclosure requirements. This is essentially a list of figures that, if material, all companies need to disclose. There are disclosures about lease costs, cash flows and right-of-use assets, and a requirement to disclose a maturity analysis. Over the next 3 slides, we'll talk about the items in the list, in particular the reason these disclosures are important. Before we do that, however, it might provide useful context for listeners to hear your thoughts, Steve, on a couple of questions we've heard about the overall approach here. First, there's a school of thought that says if the new lessee accounting model provides the information that investors want, why does there need to be a long list of disclosure requirements at all? Is not the information on the balance sheet enough? Alternatively, some have suggested that disclosure for right-of-use assets should just follow that for other non-current assets, such as PPE, and disclosure for lease liabilities should just follow that for other financial liabilities. In other words, there shouldn't be any specific disclosures for leases at all. Now, I know these questions were discussed in detail by the board. Could you share your thoughts?
Yes, of course. These are both sensible suggestions, and I have a lot of sympathy for the second one in particular, which was certainly the starting point for myself and some other board members in thinking about lease disclosure. However, there are a couple of reasons why I think the board concluded that we needed a set of specific lease disclosures and couldn't rely only on the primary financial statement numbers or the disclosure requirements for assets and liabilities in other standards. So first, we did consider requiring lease disclosures that were very similar to those for other assets and liabilities. For example, in the 2013 ED, we proposed requiring a movement table for right-of-use assets that is similar to the one that is currently required for PP&E. That suggestion wasn't well received amongst preparers because it could be very costly to do. Alongside that, we had many discussions with the investors about what exactly it is about those movement tables that they find most useful. And what we found was that investors tend to use certain specific line items rather than the whole table. And therefore, we concluded that it would be better, would better balance the costs for preparers and the information needs for investors if IFRS 16 required only those particular disclosures that investors consider to be the most important. Secondly, there are things about leases that are intrinsically different from other assets and liabilities. For example, many lease contracts have terms such as variable lease payments and other financial liabilities that the other financial liabilities don't have. In other words, leases often have exposures that the lessees don't really have on other contracts. Because leases do have these unique features, we concluded that it is necessary to have specific disclosure requirements.
Thanks, Steve. The next few slides show an example of what these disclosures might look like in a lessee's financial statements. On this slide, we've got the income statement disclosures. The first couple of items are fairly self-explanatory, the depreciation and interest expenses that relate to leases. These items enable users to understand what is hitting the income statement in respect of leases, including the finance costs that lessees are incurring as a result of their leasing activity. It's worth mentioning that the depreciation charge on right-of-use assets is one of the line items that users identified as being particularly useful from an asset movement table. Working down the table on the slide, next we have a further breakdown of the depreciation charge on right-of-use assets by class of underlying assets. For those listeners that are wondering why they need to provide this level of detail, Steve, could you explain how investors and analysts will be using these numbers?
So this disclosure requirement is for those users of financial statements, normally the equity analysts, who are looking to estimate whole asset figures. Those analysts want to know the asset that would appear in a lessee's balance sheet if it had purchased assets outright instead of leasing them. By showing depreciation expense by class of underlying asset and also applying some assumptions about the typical useful life of that class of asset, this disclosure is there to enable equity analysts to estimate this whole asset information in a more reliable way than they do today. This in turn then feeds into the comparisons that equity analysts do between companies that lease assets and companies that own similar assets.
So the final disclosure within the income statement section is expenses relating to short-term leases, leases of low-value assets and variable payments. These three items are all of the lease expenses that are recognised directly in the income statement. In other words, these are the costs that relate to leases that have never been included in the lease liability on the balance sheet. Now, this disclosure is here so that investors can get an understanding of the amount of leasing activity that is not recognised on the balance sheet. However, this is something we've had one or two questions on. First, we talked in detail in the exemptions webinar about the fact that the optional short-term and low-value asset exemptions are there for pure cost-benefit reasons. That being the case, some stakeholders have asked why there needs to be any disclosure about them. If companies have to track the information for these disclosures, doesn't that defeat the object of having the exemptions in the first place?
Well, it's a fair question, but the answer is no. It's important to note here that with respect to short-term and low-value asset leases, the only required disclosures relates to the income statement expense. We purposely didn't require any disclosures relating to the balance sheet. As is indicated by the question, if we had required any balance sheet disclosures, lessees would have had to record what would have been on the balance sheet if the exemptions were not applied, and it's fair to say this would have defeated the point of providing the exemptions in the first place. However, to provide the required income statement disclosures requires no more information to be held than that held for operating leases today. The disclosure is basically the same as the IAS 17 disclosure for rent expense. Thus, this disclosure provides useful information to users about the extent to which the exemptions have been used, but without requiring any additional information to be recorded by lessees than that which is held today.
So the other question we've had here relates to materiality. We've mentioned a few times already that the various disclosures need to be provided if they are material to a lessee. A number of stakeholders have specifically asked for clarification on this point, particularly with respect to disclosures about expenses for short-term leases and leases of low-value assets. By definition, these expenses will in many cases be relatively small, so is it the case that these amounts always need to be disclosed, or does materiality win here? Stakeholders have also asked if the board thought about specifically saying in IFRS 16 that these disclosures only need to be provided if they are material. Is that something that you thought about?
Well, that's another good question. And it's an important point across all of the disclosure requirements in this standard and others. It is the case that, as with everything in IFRS standards, that the materiality applies across the board. If a company judges a disclosure requirement to be immaterial to its financial statements, then the company doesn't have to make that disclosure. And in fact, it would be better not to do so, so that the financial statements can only focus on the information that is material. This is the case with everything in IFRS standards and applies equally to those disclosures about lease expenses. In terms of whether we thought about specifically mentioning materiality in the lessee disclosure requirements, yes, this is something that we discussed. when we were developing those disclosure requirements. In the feedback we received after the 2013 exposure draft, a good number of stakeholders felt that it would be helpful for us to indicate an explicit statement about materiality. However, whilst this might have been helpful when considering lessee, the lease disclosures in isolation, in a wider sense, it could have been very problematic. For example, imagine IFRS 16 specifically stated that a company only has to disclose the short-term lease expense if it is immaterial. Well, that could be read to suggest that every IFRS requirement that doesn't contain a similar caveat needs to be disclosed irrespective of materiality. Because materiality is a concept that applies across all standards, making such a statement in one place and not another would do more harm than good. So, to be clear, if the disclosures about short-term and low-value asset lease expense are immaterial, they do not need to be disclosed. And this applies to all of the disclosure requirements.
Thanks, Steve. Moving on then, this slide shows what the disclosure about lease cash flows and right-of-use assets might look like. The first required disclosure here is total lease cash flows. Could you explain the rationale for this one?
This disclosure was really a direct consequence of the board's decision about cash flow statement presentation. For various reasons, but primarily for coherency across the primary financial statements, the cash flow statement treatment of leases will be similar to that for today's finance leases. One consequence of that treatment is that the total cash outflow for leases will not necessarily appear on the face of the cash flow statement because those cash flows will be split, for example, into capital repayments, interest, and other items such as variable lease payments. Users of financial statements consistently told us that the total cash flow for leases is an important piece of information. And because this won't appear on the cash flow statement itself, we've included this in the disclosure requirements. Sticking with the cash flow statement theme, I'd also like to mention effective capital expenditure. This was another aspect of our discussions on the cash flow statement that we addressed via disclosure. When a company buys PP&E, there is an initial cash outflow that appears in investing cash flows on the cash flow statement. Because there's no equivalent cash flow for leases, some investors and analysts have some concerns about not having comparable information about effective CapEx between leased and owned assets. This feedback is the reason why we decided to include the additions to right-of-use assets disclosure requirement that you can see further down in the table. That disclosure is there so that users of financial statements have comparable information about the amount being invested in new leases and in new owned assets.
Great, thank you. Now, the only two items on this slide that we haven't mentioned are the carrying amounts of right-of-use assets and the carrying amount of lease liabilities. These disclosures are, of course, the amounts that are recognised on a lessee's balance sheet. The lease liability is really included for completeness. This amount may well appear on the face of a lessee's balance sheet if the lessee chooses to present it that way. In terms of right-of-use assets, carrying amount by class would have been the bottom line on a movement table if the board had decided to require a lessee to make similar disclosures for right-of-use assets as they do for PPE. We talked earlier about the fact that the board decided to just require the movement table items that are most useful. The breakdown of right-of-use assets by class is useful because it enables users to understand the lease portfolio and to compare leased and owned assets. The final disclosure that is required for all lessees is a maturity analysis of lease liabilities. For this disclosure, IFRS 16 essentially points to the maturity analysis requirements in IFRS 7 for all financial liabilities. This means that the required disclosure is of undiscounted amounts. It also means that in a change from today's requirements for finance lease disclosures, the time bands that a lessee needs to disclose are not mandated. Instead, a lessee can choose the most relevant time bands for its own particular lease portfolio. So, Steve, could you talk about why the board decided to do this? Did you consider recreating today's maturity analysis requirement for finance leases?
Well, yes, we did consider that. However, we decided instead to use the IFRS 7 disclosures for two reasons. First, so that the liquidity information provided about lease liabilities is consistent with that given for all other financial liabilities. Second, it is likely that the set of time bands that give the most useful information will be different for different lease portfolios. For example, looking at the two examples on the slide, the example at the top of the slide in green looks like a company with a lot of leases with a relatively short life. In this case, a breakdown of commitments within the first few years is the most useful information. That's because the committed cash flows beyond, say, year 5 are very small. In contrast, the example at the bottom of the slide is a more appropriate set of time bands for, say, a company that holds many long-term leases, such as properties. In this case, there is little useful information to be gained from breaking down the lease commitments in the early years into small time bands. But there is a lot of useful information in the longer-term maturities because this lessee has many commitments running up to 15, 20, and 25 years. Coming back to the point I made at the beginning of the webcast, the benefit of permitting judgment here is that the lessees can provide a maturity analysis that is most useful for their own lease portfolio.
Coming back then to this slide from the beginning of the webcast, everything we've talked about up to now summarises the mandatory quantitative information, i.e. the first part of the two-part IFRS 16 lessee disclosure package. Now, the second part of the disclosure package is what we tend to think of as additional entity-specific information. This is essentially a requirement that if the disclosures we've already talked about are not sufficient to meet the overall disclosure objective, then a lessee needs to disclose any additional information necessary in order to meet that objective. In practical terms, additional disclosure will be needed if there is any information that users of financial statements would need in order to assess the effect that leases are having on the lessee's financial statements. The standard then goes on to give a list of examples of the kinds of things that a lessee might need to disclose in order to comply with this additional disclosure requirement. It's important to note that unlike all of the mandatory quantitative disclosures we've been talking about, paragraph 59 in the standard about additional disclosures is not a list of required items that all lessees must disclose, but is instead an objectives-based requirement for a lessee to think about whether and what extra information is needed. A lessee will need to use judgment in applying this requirement. So there's really two questions here. First, does a lessee need to disclose anything at all? And if so, what should those disclosures look like? Starting then with the first of those questions, whether to disclose anything at all. Steve, could you talk about the board's expectations here? Were you expecting that all companies will need to disclose additional information beyond that we've already talked about?
So in short, no. I wouldn't expect all companies to be disclosing additional information. When the board discussed the lessee disclosure requirements, our expectation was that there are many companies that will not need to provide any additional disclosure beyond the specific mandatory requirements. That's because those mandatory disclosures are expected to provide sufficient information for leases that do not have complex or unique features. If a lessee has a portfolio of simple leases with fixed lease terms and fixed payments, then user needs are likely to be satisfied by the mandatory disclosures, and the entity can just stop there. But on the other hand, the lessees that will need to provide additional information are those with unique or complex lease arrangements which a user would want to know about. For example, if a company has variable payments in many of its lease contracts, such that there is exposure to future lease payments that isn't reflected in the balance sheet, this is something that users would want information about. Without understanding those variable payment arrangements, a user wouldn't be able to assess the effect that leases are having on the company's financial statements. When that's the case, the lessee needs to disclose additional information.
The challenge for companies is, of course, where to draw the line. For example, to what extent do complex lease terms need to exist for a lessee to need to make additional disclosures? Listeners may be wondering about the burden of proof here when additional information is not disclosed. Were the board expecting lessees to prove why additional information doesn't need to be given? I think the concern from companies here was that this could be potentially costly.
Yes, this is a very relevant concern and again something that we considered in developing the requirements. There are several reasons why we decided to write this part of the disclosure package in an objectives-based way rather than giving a list of requirements. And one of those reasons was to remove that burden of proof from companies. I talked at the beginning about the problem of boilerplate disclosures today. Companies have told us that one of the reasons boilerplate disclosures happen is because when faced with a list of specific requirements, it's often easier to just disclose something than prove that nothing needs to be disclosed. Because of this, we specifically avoided writing a list of requirements for these additional disclosures. The goal here is really to move the focus of companies away from complying with a list of standard requirements that may not be the most useful information. Instead, companies can judge for themselves what is the genuinely useful information in their particular case and concentrate only on disclosing that. In practical terms then, what does this mean? What users of financial statements really want to know is very likely to be the same information that is used in managing the business and making decisions about lease contracts. Therefore, in deciding whether anything needs to be disclosed, a great place for companies to start will generally be their internal management reporting packs. If there is information about leases that senior management are interested in, then it's a very good indication that the information is something that users of financial statements, that they will also be interested in.
So, assuming then that a lessee has some complex, unique or otherwise significant terms within its lease portfolio, and that information about those terms is monitored and reported internally, it's likely that some additional information needs to be given. So moving on then to some specific examples, this slide shows examples of the types of lease activity that might prompt a lessee to provide some additional disclosure and some examples of the kinds of things that might be useful information in these cases. These items are all included as examples in the IFRS 16 application guidance. The illustrative examples in the standard also have 6 detailed disclosure examples, 3 relating to variable lease payments and 3 relating to extension and termination options. As an example, let's look at extension and termination options. So what is the kind of information that users want to know here?
So at a high level, what users are likely to be interested in is understanding the rights and exposures that a lessee has that are not evident anywhere else in the financial statements, and the economic effect of those rights and exposures. They're also interested in understanding the things that factor into companies' decision-making about its lease portfolio. So taking, for example, the first item listed on the slide under extension and termination options, a relevant piece of disclosure in many cases will be why a lessee wants those options in its contracts. It is generally going to be the case that a lessee will have to pay for flexibility in its lease contracts. From the lessor's point of view, a 10-year committed lease is far less risky an arrangement than the same contract in which the lessee has an option to exit after 5 years. Therefore, if contract terms such as termination options are included, the lease payments are likely to be higher to reflect that flexibility. That being the case, it's fair to assume that the lessee will have good reasons for negotiating these lease contract terms. The information about what those reasons are will be something users and indeed internal management will be interested in. For example, companies have given us examples of times when they use extension and termination options in contracts for operational flexibility. Say, for example, a retailer might want optional break clauses in its store leases so that it has the ability to pull out of a location if that location is underperforming. In this example, and coming back to my earlier point about internal management reporting, it is likely that those within the company making decisions about financing store locations will be very interested in the flexibility being obtained and how much that flexibility is costing. This information will enable informed decision-making when negotiating lease contracts. So in this case, the most useful information might be information about the historic exercise rates of extension and termination options. For example, if this retailer typically exercises a decent proportion of its break clauses, then that suggests paying for flexibility in the contracts is worth doing. If on the other hand, break clauses are almost never exercised, then it might lead to the lessee to stop paying for this flexibility going forward and just negotiate fixed contract terms. But the key point here is that the information that leases should be thinking about disclosing is a direct reflection of the information that's actually used in managing the lease portfolio and making decisions about it. Another example that you can see on the slide is the relative magnitude of optional payments to those fixed payments. This could be relevant, again, both to internal management and to investors and analysts in understanding exposures that do not appear on the balance sheet. If a lessee has a lot of optional lease payments that are not reflected on the balance sheet, then in order to fully understand the effect that leases are having on the financial statements, a user would need to know about those payments.
So in summary then, on the additional disclosure requirements, is it fair to say that the board weren't expecting companies to produce new information purely for the purpose of complying with these requirements?
Yes, that's absolutely correct. We wouldn't expect companies to do that, and indeed investors wouldn't want them to either, I don't think. To sum up, what users of financial statements are looking for is information about the things that really matter to a company. The information that is sufficient enough for internal management to both monitor and to use in making decisions. Companies are not expected to produce information purely for those disclosures. Instead, they should base those disclosures on the information that is being used by the business to manage its leases.
One final question we've heard is around disclosure costs. Could you comment on what the board's expectations were around whether IFRS 16 disclosure will be more costly for lessees than today's IAS 17 disclosure?
Well, I guess the answer to that question really depends on the entity. We'd expect more disclosure and higher cost to be incurred by entities with complex lease portfolios. That's firstly because a complex lease portfolio would require more detailed and therefore more costly disclosure in order to properly report that portfolio to users of financial statements. And secondly, investors have consistently told us that information provided today about elements of a lease portfolio, such as options and variable payments, is often insufficient. In order to address that lack of information, IFRS 16 does require more information about those things when they are relevant. But on the other hand, if a company has a simple lease portfolio with no complex terms, I'd expect less disclosure than today and lower cost to be incurred in making that disclosure. That's because these leases will need to disclose only what we discussed in the first half of the webcast, i.e. a table of numbers and a maturity analysis. It's also important to note that all of these items can be systems driven. In these cases, IFRS 16 disclosure would be a straightforward exercise to produce. There will be no need for the sometimes lengthy disclosures that are seen today, because in the absence of complex lease terms, there's nothing in the new standard that will require a lessee to disclose anything beyond the table of numbers and that maturity analysis.
Thanks very much, Steve. So we've now talked through the lessee disclosure requirements in IFRS 16, including background on why the board arrived at these particular requirements and how users of financial statements are expected to use the disclosed information. This final slide provides a link to where further information about Leases implementation can be found on our website. The Leases implementation page summarises all of the work the board is doing to support implementation. Within that, there's links to previous IFRS 16 webinars. We thank you for listening to our webinar and hope that it was helpful.